Hi, welcome to Market in a Minute. It's time to be tactical, and this is from a baseball movie with Clint Eastwood in it. But their big recruit had a lot of problems with hitting the curveball. The name of the movie was Trouble with the Curve. So the stock market also has trouble with the curve. But before we get into this, obviously it's no longer kind of baseball season and focus. It's now moving to football in my mind. So Lee Corso on Saturday, he nailed it. He was the only one that took Vanderbilt to beat Virginia Tech. Virginia Tech's supposed to be good this year, but he hit it, man. I'm very surprised. So time to be tactical. We've been talking about September being tough, a tough month for the markets for a while now. And we put a piece out last week. The last four Septembers, the average down was about 7%. And so we think September is going to be a tough month, maybe choppy to begin with, and then down more in the latter half of the month is our best guess at it. But it's not starting out very good on Tuesday. So the market is way overweight on technology. So obviously we talked about this last week as well. We thought that the quarter for NVIDIA would be more or less in line with expectations that were consistent with prior quarters, up about $4 billion of growth sequentially, and a little bit of a surprise on the earnings. And that's exactly what they did. And obviously the market already knew that. So after 6 quarters of these surprises, the market caught on to it. Pretty easy to figure out, and the stocks pulled back. We don't, we're not big fans of Nvidia because of the large market cap, and they don't have the recurring revenue base that companies of that size have to support that large market cap. So the market is kind of waning now because of the lack of momentum in Nvidia's business. So we think that the market is discounting a lot of the growth already expected for 2025, and also the interest rate cuts by the Federal Reserve of approximately 1.5% drop in the federal funds rate in a reasonable time, say over the next 6 months or so. So a lot of that's been discounted. So we're looking at the market pulling back and thinking, this is a really important time to be tactical, protect your downside, and look for those opportunities to buy good companies when they're down, or buy the particular indexes when it's the right time as well. So time to be tactical. And as you know, that's kind of our investment philosophy, loss averse investment philosophy, to be tactical in that sort of overall philosophy. So trouble with the curve. If you look at what's happened over the last 40 years or 50 years roughly, the market, you can see this when there's an inverted yield curve and when the inversion ends. So this is basically the 10-year minus a 1-year treasury. So when the yield curve becomes uninverted from being inverted, so it means that the shorter end of the yield curve really comes down in a big way. That's when the recession usually starts, somewhere around there. So the yield curve, when it's inverted, has generally always predicted a recession, and we think it's probably doing the same thing currently. But the stock market doesn't believe that, but it seems like the bond market does. So if you look at the shape of the yield curve here, you can see that the 1 year is currently around 4.4%. So it has not come down to where the 10-year is at 3.8, but the 2-year is. So I think it's likely that the 1 year comes down to maybe 3% over time, so be much lower than the 10-year is currently. And so all this right here has to come and de-invert. So it comes down in a big way. And it's doing that if the economy is weakening. So the Fed's not going to cut in a big way if the economy is not weakening. So the stock market believes that the economy is fine, and the bond market believes that more or less we're going into recession, having 1.5% already discounted in the federal funds rate dropping. So another important thing is we're really surprised that the Federal Reserve, Jay Powell, doesn't make a bigger deal of the fiscal policies of the government. That's really preventing them from doing their job very well. Obviously, they made a lot of mistakes, compounded with the mistakes that the Biden administration made on spending so much money. It's now getting rectified a little bit, but they're still spending way too much money. So I'm surprised the Federal Reserve as a group hasn't come out and said, hey, we need to pull back the size of the federal government and allow the rest of the economy to grow more and take the pressure off of inflation. So the employment report on Friday, we think will set the tone for the overall market. So and what we mean by that is if the Federal Reserve is cutting rates because they can versus because they have to. So if they're cutting rates because the inflation rate is now considerably below what the federal funds rate is, and they can ease off of that and bring rates down to a more normal level, more equal to the inflation rate, which is roughly 3% or less. Or is the Federal Reserve having to cut rates because the economy is weakening and going into recession and the unemployment rate's going up? So as you can see here, the unemployment rate bottomed in April of 2023 at 3.4%. Now it's all the way up to 4.3%. The current expectations for unemployment on Friday is 4.2. So they think that the unemployment rate is going to go down a little bit. Hard to argue, we don't have a very good read on really good numbers and getting any sort of consistent pattern out of these reports, given how badly the Bureau of Labor Statistics have missed everything. So, that's roughly been 68,000 per month in wrong expectations that they had to go back and readjust to. So the expectations for new jobs in August is expected to be 165,000 jobs, up from 114,000 jobs in July. So if the new jobs are in line, that's fine. 165, that's fine, and they can cut rates. If it's too strong, then they're going to go at a slower pace, and if it's too weak, they're going to go at a faster pace. But the market's not going to like that. So we think the overall tone from the unemployment report is very important for the overall stock market. So the market expectations, we think that the market is now discounting almost best case. So currently the market PE is 23.3 times 2024 earnings, which is high. Just keep in mind, the forward 12-month PE in 2000 got to as high as 25 times. On 2025 earnings, it's about 20.3. That's still high. So that number factors into a lot of the rate cuts expected to occur over the next, say, 12 months. So that factors in a better valuation environment, yet the economy still stays strong and earnings grow at roughly 15% next year. That's a lot of ifs, right? So we think that the market itself is discounting both positive earnings and a lot lower interest rates, and the economy staying strong. That's going to be hard to put all those together. So we expect that the economy to grow slower in 2025 than it did in 2024. And so we think that the earnings multiple on 2024 earnings at 23 times, it's really high, and it sets up a high probability for disappointments. So if you look at the earnings growth for next year, here it is, the S&P at 15.3%. So a nice acceleration versus last year, and not sure where that acceleration is going to occur. But if you look here, healthcare improves quite a bit. I can buy that. Some of the names in the healthcare space were depressed in 2024, so a little bit of recovery makes a lot of sense. And it's not dependent upon the economy to get that sort of improvement. Technology, it seems a little high at 20.5%, given that the momentum in NVIDIA's business, which will carry over to other semiconductor companies and other tech companies, is they have the problem of large numbers, right? So it's hard for them to keep growing at the pace they've been growing. So growing over 20% seems difficult. Materials, this is just pricing action. So thinking that 18% growth out of materials, it has to have a really good economy to get those price increases through. And communication services, this is Google and Meta, so that seems reasonable to me at 16.9. And industrials seem a little high at 15.9. So everything seems to be nicely positive this next year. It seems the market has some rose-colored glasses on at this point, and those expectations will be guided down sometime in the near future. So one thing that's really intriguing is the cash. So there's a lot of cash on the sidelines, a lot of cash in money market funds, roughly 6.4, 6.5 trillion dollars of cash. You can see that how what the cash has done over the years. So when the Fed really got aggressive, and so did the federal government, the cash really ballooned to a level that's historically very, very high. And we think that that cash will come back into the markets, maybe not all of it, but some of it will come back into the market itself. It'll be a nice fuel for the next bull market, but it won't happen likely until probably the 1-year treasury gets somewhere around 3%, maybe lower, maybe a little bit higher, but somewhere in that range, which is very doable over the next, say, 12 months. A new bear market might set up, but it's going to have a weak economy to get those rates down to that level. So there is quite a lot of cash around, and liquidity drives bull markets. Now politics. So we're in Denver, and not used to seeing us a lot of national news about Denver, especially what's going on with the border crisis. So, Denver is a sanctuary city. Colorado is a sanctuary state. Both the mayor and the governor endorse those policies. What's happening is that Denver is overcrowded. They can't support all these illegals anymore, and they're pushing them to the surrounding cities around Denver, like Aurora, which is really close to Denver, and causing some major problems. So we think just in general, our country is getting sick of all this, sick of the crimes, sick of the benefits going to illegals that are not, obviously are not coming in the proper way into our country, and ignoring the citizens themselves. So we think there's going to be a big backlash. We think this election, very simply, it's about throwing the rascals out. So these policies have to end. It's not fair to the people that are here. It causes all sorts of problems. The border crisis does. There are other issues, obviously, but this is starting to hit home with everybody. So, thank you very much. Please hit like, subscribe, do whatever else they ask you to do on YouTube, right? And be cautious this month. Keep some powder dry. Look for some opportunities. Thank you, and we'll talk to you next week.